Hey, we're live. Richard, you're there with me. All right, everyone. Good to see. Can everyone hear me? Let's just make sure everyone can hear me first.
I hear you.
You hear me. Excellent. Isabella from Vienna. I wish I was in Vienna right now.
Yeah, me
Stefano
too.
from Italy. Well, look at all the Italians. Giandrea. Oh, boy. Boy, oh, boy. Got all the Italian connection. I need to start learning to speak Italian. That's what I need to do.
That's easy. You just speak sort of Spanish with an A or an O on the end.
Oh, is that all there is to it? Oh,
Yeah.
if only I had known that. Oh, got Andre from the Netherlands. Excellent. Dev, Stanislav, Stefano. All right. Great.
Actually,
Great,
people
great.
say that Catalan and Italian are very similar.
They do, yeah. Yeah. My Catalan friends always say when they go to Italy and they read a menu, it's almost exactly Catalan, except sometimes just extra letter here and there, but it's practically the same thing. So that's pretty cool. There's Antoine.
You realise we just insulted two whole nations.
I don't think we insulted them. We talked about their incredible similarities. Yeah, cultural exchange here. Yeah. So as you can see, today we've kind of swapped roles. Richard's off in Dubai, and I'm in Richard's office. So here's my best Richard impression. I grew up in Canada, so I'm going to try to pretend I'm from the UK. Hello, Governor. My name's Richard the Razor Hodges. Right, that's all I got. That's as good as it gets.
Richard the Razor, I like that.
Yeah. Is that called the Cockney accent? Is that what that is?
Well, the Cockneys are from the east end of London.
Okay.
And so you've got that sort of archetypal accent that was butchered on Mary Poppins by what's his name?
Oh yes. I'll think of his name in a little while. Dick Van Dyke.
Dick Van Dyke. Yeah. That was the most god awful Cockney accent in the universe. But...
Did you know he's still alive? He's really quite an interesting chap, Dick Van Dyke. Anyways, enough of that. All right. So let's jump on it. Everyone can hear me. We got lots of people with us today. Good to see you. Let me just set some things up here. I'm going to first off, no, let me let's take a look at the charts first. Then what we're going to do is we'll look at the poll. Okay, we've got a poll question regarding last week's trade, and then we'll start to talk about the topic of this week. So without further ado, quickly, let me just, jump over to my silly charts. Interesting. So here we're looking at Bitcoin. And, last week I put this little line here. I talked, and we were pushing up, if you recall. And I said, hey, I don't expect it to go through that line. If it does, it's going to hit some resistance. I don't expect it to just fly through, maybe wick through and come back. I expected it to pull back, and it did. Every now and then, I'm right. It's kind of hit a range, but we can see that it's still kind of strong. We're still on an uptrend, right? And if we were a technical person, we'd go, okay, well, we still got this uptrend, right? Well, we do. So, there's no reason to think this might not continue up. And actually, just before the call, when Richard and I were chatting, I think, Richard, the term you used was you were starting to feel the beginnings of strength starting to build in Bitcoin. And is this, people's attitudes going forward into the halving, kind of position themselves just in case there is a big run up? I don't know. But when we come over and we look at Ethereum, it had a run up too. But I mean, we've pulled back directly, like smack dab in the middle of that former channel. And I don't expect that to change very much. I wouldn't be surprised if it came down to the bottom of the channel. I wouldn't be surprised if it popped up to the top either. But I don't expect any big moves in ETH. Now, if Bitcoin leads the charge and goes on a tear straight up, sure, it's going to drag Ethereum up with it. I'd expect resistance in some of these areas up here. But right now, I'm not doing very much. I'm just selling short-dated stuff. I'm kind of sitting on it. I've got a lot of stuff expiring tomorrow, Friday, on the 6th of October expiry. When that's all gone, I'm probably going to be inclined to sell another iron condor. I'll probably do it on the 20th or the 27th. Not very far out. I'm going to keep it within 2, 3, 4 weeks, I think, just because I'm a bit wary of what Bitcoin might do. and wary, not worried, just cognizant of it, and I want to take advantage of it. Right now, I must admit I am a little bit short delta in ETH in my own position, so I am kind of anticipating it to come down to the bottom of the range. Who knows? But I'm okay either way. So that's the other thing I wanted to mention here is when we look at these two charts, well, we can see that this is the Bitcoin range. It broke up above, and all we're seeing I guess what I'm trying to say is they're living different lives now. Before, they were so closely correlated, and they still do have correlation, of course, but they're starting to diverge. And is this temporary because of the halving? Is this just the beginnings of them being completely on their own? I don't know, but they are quite different. And I think Richard pointed out too that the vol spread is a bit different because Bitcoin's got a bit more volatility. Now, on that last spike up that happened a few days back, vols did spike up, and they did stick. They came off a little bit, but they did stick. Bitcoin is a bit stickier than Ethereum. Now, looking now that we've looked at that chart, as you recall, last week, after the end of the call, the consensus was to put on an iron condor. So I did. I built it in 2 stages. We had that spike up. I sold some calls up there, but lightly, because I expected, or I was prepared for it to keep going, and I wanted to scale into it. Didn't want to put it all on at once, but it didn't happen. It pulled back. Then I put the put side on. So here's the poll. Let me publish it right now. So we do have an iron condor. It's the 13th of October. I wanted to keep it short dated, so it was 2 weeks at that time. Now it's only 7 days left to expiry. It's the 1400, 1500, 1800, and 1900. So the 14, 1500 is the put spread, and the 1800 is the call spread. Now the short puts, when I looked this morning, they were showing around 10 or 13% profit on those. On the call side, though, about 70% profit. So my question for you in the audience is, what do you think with this? And I'll tell you what I think afterwards, but do you think we should just sit tight and wait? After all, it's only 7 days to expiry, right? We're going to have a rapid decay in there. Or should we maybe close the call side? The call side's got the profit. We could just close it and walk away with that money, right? Nothing wrong with that. Or maybe roll those calls down. So we could roll them maybe from 1800 down to 1750, or 1700 might be shaving it a bit close, but anything's possible. We could do whatever we want. Or just close the whole darn thing out now and walk away. We've got profit on both sides, not very much on the put side, but we could do that. So let me know your thoughts. And at the end of the call, we'll come back to that. So let me just go back quickly to the slides here. Or actually, Richard, why don't you share your screen first and just talk about what you got going on, and we'll come back to the slides and then we'll get into today's topic.
Yeah, sure.
I figured since I did my best UK accent, I figure you need to do your best Canadian accent. Just say A after, right? I guess.
That's right. We're heading oops. Hi.
And just say you're sorry all the time.
I don't really know many of your Canadian idioms. I'm going to go out and hunt a moose or something. I don't know.
Yes, exactly. Yeah.
Right. I haven't done a lot this week, actually. I've, as you know, in this home, I'm kind of just short calls. I'm actually short some futures as well against my Bitcoin. So I'm holding about 2 Bitcoins and I'm short about 1 Bitcoin in futures or perpetuals. I really should actually buy those perpetuals and sell the dated futures, because there is a interest rate spread on those right now. Perpetuals are average funding cost is about 3%, and the funding cost on futures is about 5.2%, 5.3%. So I really should be playing the perpetuals against the futures, but I just can't be bothered. I need to write a program to do that for me. I did have a short call expiring tomorrow, 28,250, and I didn't kind of like it. It was a few basis points in profit, and I thought, just take it off the table. And I resold it out at, I think on the 20th of October, I think I sold something there. And what I'm seeing in terms of implied vols, this is the 27th, I think I'm seeing. I did sell a couple of puts, just I mean, really small, like 0.1 in November and 0.5 in October. I don't like selling naked puts, but I was looking for some vol somewhere, and there's a bit of downside skew, not much. It's a funny market because the market's showing a bit of feeling like it's starting to show strength in the spot market, as you say. I wouldn't say strength, but at least resilience to going down. And at the same time, implied vols are being crushed as ever this year. So we're at 30% vol at the money in the 1 month, which is kind of almost enough to sell if you're not going to hedge every day. On my systematic book, I'm not adding any risk at all right now. I just feel that leads on to the topic of this talk. And the skew, the upside skew isn't really, well, it's negative. So the upside skew is almost cancelling out the smile. So there isn't really much value in selling anything on the upside either. So I'm just kind of letting it all decay a bit and just see what happens, I think. If I were to do anything clever, what I might do right now is sell ETH volatility and buy Bitcoin volatility as a kind of a correlation spread, vol spread between the two markets.
So sell ETH and buy Bitcoin.
Yeah, the vol, right? Not the underlying. So I might, for example, sell a strangle on ETH and buy a strangle on Bitcoin, for example. Because normally there's normally about a 5 vol spread between the implied vol of ETH versus Bitcoin. I mean 5-ish, and right now that spread's down to about 2.5. So it's kind of tempting to start looking in that direction for inspiration. If we start to see implied vols on Bitcoin get down to about 28 at the money or lower, I will start systematically buying back all my short positions, and I'm very happy to actually let the book get flat between now and the end of October, with a view to look. We're just waiting on some kind of event to spike some vols in there, because right now, one of those situations. I coined this phrase back early in the year. I was talking to the Paradigm guys. It's too cheap. It's too expensive to buy, and it's too terrifying to sell. Kind of the you kind of get that feeling. So that's kind of where I am.
Yeah, and I get what you're saying. I didn't really say it, but I've been kind of feeling the last few times when I go in and I look for things to do, try and find ways to make money. I thought, you know what? I really wouldn't mind being flat. And I'm kind of looking at these sparks coming up. I'm like, okay, after the 6th and after the 13th, I'll have some stuff on. Obviously, I've got the diagonals and longer dated things, but I'm actually quite happy to be flat right now. I just get that feeling, and I think that even in our chat, I think maybe Dom was just saying that he's his trend system, whatever he's talking, is starting to look strong, and I think we're all kind of feeling that it might be ready to start to move up, and maybe the best thing to do is just kind of sit on our hands and wait. And we do have some. I do have some positional things. I've got those longer dated call options, those diagonals on Bitcoin, so I'm quite happy if it goes up. But yeah, for vol sellers, be careful.
Yeah, I was going to say that I kind of would sell calls into the rally if the skew was positive, but right now the skew's negative. There's a bit more vol inputs than there is in calls, and I'm very happy to sell calls into a rally and hedge it, because I know I can win by climbing the smile. But at the moment, just not enough of a where was the 1 month, the 27th of October. I mean, don't be fooled by this graph. Okay, yes, the 12,000 put is at 120 vol, but let's look at where the smile really is, right, between the 10 deltas. Actually, the smile is, you can't really tell. It's slightly skewed towards the puts for the 3. Yeah, and I'm happy to sell calls all day long if the skew is positive, because I know I can out hedge the smile, but at the moment, it just doesn't feel worth it. But, I mean, yes, I'll make money, but not enough to make it worthwhile losing sleep over it.
Yeah, no, because if you do get a big, multi standard deviation event, it could hurt. So
and it's very embarrassing to have sold vol at, say, 35 and then see it's currently now at 55 and have to explain that to yourself or worse, somebody else. Right?
Like Dom just said, it, not enough meat on the bone. So there you go.
Yeah, fair, right?
Nice.
Yeah. Yeah.
Okay.
Which I think is another segue into our topic today. Right?
Yeah. Let me just here. Let me cancel this and.
Should I stop sharing?
Yeah. Go ahead. Yep. Okay. So basically today, we want to talk about understanding probability and become a better options trader. And this is, I mean, we could sit down and have coffee or beer or whatever we want to do and chat about this for hours, really. And this is the things that we sort of do talk about. But it's going to be nice to talk about this with our members a little bit because, there's a lot of parallels between other activities in life and trading, and a lot of false assumptions as well. But probability is a huge component. And when we're talking about delta, one of the 4 primary components of delta that we're using is a probability indicator. If you've got a 30 delta call, well, if you've bought that, you've got a 30% chance of expiring in the money, or the market thinks that at the time.
Roughly.
If you've sold it, you've got a 70% chance of expiring out of the money. So we're using delta as a probability all the time. So probability is nothing really new in options trades, but it's actually very, very, very important.
Okay.
So I'll just, we don't need that on.
Oh, we don't have a slide. Right, yeah. Okay. So I was kind of expecting there to be some funky graphics here, but it's just little me. So I wasn't allowed to say this for the title of the episode, but I think I can say it here. So there's a big difference between gambling and betting. Is that fair? There are people who make bets on a professional basis, including on horse races and card games. And those people who do it professionally are not gambling. They're not, because gambling is, make a bet and then pray to whatever icon you've got that you'll be really good if your number comes in, or you just bet with the assumption that you're going to statistically bleed money all night long. But a professional gambler, and it's the wrong term really, but that's the term we use. Professional gambler is somebody who understands probability very well. And even though they are operating within a game that is rigged towards the house, or in the case of horse racing, rigged towards the overround of the bookies, and they will make money consistently. And it's because they understand probability and also understand the indicators of probability in the particular game on which they're making bets. And we can be fairly, let's not beat around the bush too much. We are trading options in a cash settled market. That's the very definition of a bet. It just happens that the payoff curve is not binary. And we owe it to ourselves then to make those bets in an informed way. We could think of the market makers as the house. They're building in an edge by charging a bid and ask spread on the vol surfaces or the prices that they're coming up with. And we are paying those spreads on the whole. And we're also paying a small fee to the house, to Deribit, for the privilege of trading on their platform. And, we can't argue about that too much. If we weren't paying them, we'd be trading in TradFi, and we'd be paying a broker for his time and effort in spending our money in the club or the golf course. So, and that's the game we're in, right? So we accept that we come to this table and we don't have the edge because we are retail. And actually, by retail, I even mean a hedge fund still comes to the table as a buy side, so he's paying those spreads. So how do we skew the odds in our favour? We do have in our favour, much like blackjack, and I don't mean to flippantly claim that trading options is just like blackjack, but it's actually just like blackjack if you're playing it properly. Which is that if you're playing blackjack and being fair to yourself, and you evade detection by the house, you will limit your bet size when the odds are against you, or even not play at all. And when the odds are in your favour, you will increase your bet size. This is the very essence of card counting. And for anyone, I'm sure you all know what card counting is, but just in case anyone's watching who doesn't, card counting is the art of watching which cards get turned up from the deck and you decrease the count when you see a 10 or a picture card, and you increase the count when you see a low card. I think it's 2, 3, or 5 or something like that. And you're looking for the ratio of low cards to high cards. And why is that important? Well, because when there are lots of high cards in the deck, the chances are good that a dealer will deal himself a 10. And dealers hate being dealt 10s because about half the cards in the deck are 10s, right? So, because if the whole dealer's holding a 6 or lower and he deals himself a 10, he has to take another card. And there's a 50% chance that that's a 10 as well, and then he's bust. And if he deals himself a 7, he must take a 10, which gets him he's going to take a 10, which gives him a 17, and that's the card you're going to beat, and so on, right? So, so it's similarly to the casino where the pit bosses aren't watching. We have the same advantage. We can sit and notionally, in quotes, count cards, and we can definitely choose when we do and when we don't bet, i.e., when we take positions off and when we put positions on. So, and I'm using a huge metaphor here of card counting versus options market. What is it in the options market that is the card count? Well, for me, and I suspect the majority of us, we largely trade volatility. And what we're really trading is the probability of getting in the money on whether you're short or long, you either want to be or don't want to be, to simplify. And the probability of that is very much dependent on the actual realized volatility of the market. And there are two volatilities, but I'm sure we're all aware. There's the realized volatility of actually what is the standard deviation of the average move in the market squared, and the implied volatility, which is what prices are in the options, what volatility are they implying. And at the moment, we see that implied volatility, if I go back to screen share, might be slightly more interesting than here we're trading on share. So Deribit has this very kind of handy little chart. You can look at the historical volatility. So this is the annualized volatility, but taken daily for the past 15 days. So we're currently trading, it's like a weighted, is it weighted? I forget now. But the current realized volatility is more or less exactly 30%. And the current options vol, the devol index is currently 37. And if I go and look at the money 1 month right now, I think we'll see that it's 30. Okay, so what's this telling me? Well, the blended devol is 7 vols above the realized vol, but actually right now the at the money 1 month calls and puts are pretty much trading at exactly the implied vol, which exactly matches the market. Which kind of means if you buy or sell that option, let's assume that the realized vol is going to stay the same. That's at 30 or thereabouts. You're basically making a 50-50 punt, win or not. That's the long and short. And by winning, I mean, if you buy the call, then the call gets deeper in the money than you paid for, and if you sell the call, it doesn't get any deeper than you paid for it, and so on. So that feels to me like a total gamble. That means that's the same as just walking into the casino with my eyes shut and placing a bet on the blackjack table. If I see realized volatility go higher than this, but the at the money vol stays at 30, then actually that implies that I should probably buy the option. It's a pretty strong signal that I should buy the option. Now, bear in mind that the realized volatility is a standard deviation, and the markets don't always operate within one standard deviation, and so there's always the probability that we'll get an extra, bump in the spot. But long and short of it, you can kind of say on average, if you write a small position every day at a random strike, and you're doing it at similar vols to what's being realised or what's being seen in the market, then you are basically just gambling as whether you're going to win or lose. And that's kind of why I'm in the frame of mind right now of reducing my short positions. I'm not rushing to reduce because we might get another couple of vols sell off, in which case I'll make an extra $500 on this account. And I'm not massively concerned about vols spiking, in the next 48 hours either. I don't feel there's much. We've got Friday tomorrow. There's no real announcements happening, and then we've got the weekend. I would imagine, well, if this carries on, we'll get a vol crush into the weekend, and I'll probably put some buy orders in on Saturday to buy this back. But neither is there anything compelling me to say, you know what, I should be starting to up my bets at the table, because there just isn't. No, the reason I wrote this half a Bitcoin of downside risk at 24,500 was, well, that down there we're pricing at 42 volt, so we're pricing in the possibility of a jump in the market, and bigger than one standard deviation move a day, and there is always that on the wings. The wings are dangerous and get priced accordingly, which is kind of why I trade them, because I find often it's easier to get a mispricing out there than it is at the money, because I think people tend to focus very strongly on the 25 delta to 50 delta range, and the wings often get bought as an afterthought to protect people. Iron condor people buy the wings and won't really count the price. So that provides an opportunity for people like me to go and hunt out there for mispricings. But what I'm betting by saying writing that put is, I bet that there won't be a 2 sigma move in the next 3 weeks, or definitely not a 3 sigma. But I'm not betting. I'm not making a strong bet. I'm like short, I don't know, 5 or more Bitcoins of calls, and I'm short half a Bitcoin of puts, because I'm weighing up my knowledge of the market. We've had a push up. It's not that strong. We're not in the halving season yet. I'm kind of okay being short calls. Even at 20 delta, I'm okay. But puts, treat with care. But if we had another $1,000 up move, and the vols skew up towards the upside, and we started seeing 50 vols on the calls again, I'm happy to get in there, and that's when I'd start increasing my bets. And if we had a push down to 25k and scared everybody off, and I saw the vols jump to sort of 60 or 70 on the downside, I'm willing to take that bet, because we've probably seen maybe a 40 vol in the market realized, and I'm pricing at 60. I'm okay with that. And this principle applies whether you're going long or short vol. What you're looking for is the spread between the realized and or what you think is going to be the realized and the implied. That's pretty much the basis of value. Now, this of course implies that you are pricing positions and then delta hedging to be 0, or you are writing, every day. And in fact, I do both delta hedge and I write a little bit of risk every day to try and capture the sort of average of the move and not get too pinned to one strike, which is why you'll see I've got options short all kinds of strikes here. So that's the kind of the basis of this. So the long story short, when the vol spread between implied and realized gets crushed, I start taking money off the table, and when the spread widens, that's when I get keener to start adding more risk. So you'll see me as one of the first people to start going against the trend and selling calls into rallies and selling puts into sell-offs, because that's when you get max fear. Actually, a bit different on rallies. At rallies, you tend to get max fear just before the blow-off, when everyone has to short cover, and that's a great time to go piling in. If you see that spike in vol, and normally it's a skew with a vol spike on the at the monies. That's the signal for me to go piling in, because I know now that the count's in my favour. Yeah, so that's kind of where I'm going with this.
Yeah, I think that's very wise, and I think too many people just always do sort of the same bet all the time. And I say bet by trading the same size all the time. They're always risking 10% or 1% of their count, or whatever their system happens to be, or they always have their margin at a certain amount. When really, we like the gambling analogy, it's kind of wise to back off sometimes and sometimes go harder, and that's ends up affecting your bottom line. And of course, there's always going to be regrets. There's always be, oh, geez, I should have went in bigger, or oh, why didn't I reduce the size? Yes, that happens, but we need to follow a system. You need to trust your gut, and you need to just look at the data. And I think that when things don't seem favorable, well, just don't be there. And I've said before, the gift of being flat. Sometimes it's nice just not have anything. Let the market go crazy, and because it's nothing worse than a world. We've all been there where we regretted having a position. So just want to quickly mention too, we always have a 7-day free trial. Go over to roguetrader.academy and sign up for any of our plans for a 7-day free trial. Of course, silver and above, you get the interactive real-time chat with us every day, and jump on our calls with us every Monday, as well as joining us here on Deribit Live. So any questions, please put them into the Q&A. We do have a question from a couple of questions here. We don't have a lot of time left. Just before I finish, let me just go to the poll. Now, this poll is oh, you're still sharing your screen, by the way, Richard.
I did that in response to something that, that one of the guys said. This was, it was, I think I moved to the question thing, but I think we might have deleted it.
Let's see.
Oh, there we go. It's in the chat. In response to something Alex mentioned. So,
okay.
Speaker reviewed in delta terms, yeah, instead of strikes. So I was just going to say that this is a Jupyter notebook using the analytics by Immersive Finance, who are great friends of mine and also the incredibly gifted organization. So you can see the top line of that little table in my window, where it says row 0, 1 month, and this was taken from earlier today. But you can see that this is how I express volatilities. This is how I see a vol surface. So I'm looking at the 1 month expiry, 30-day now. The money forward was 32.61%, and then the skew is the RR bit. So it's the risk, what we call the risk reversal. So what's the difference between the volatility of the calls for a given delta and the volatilities of the puts for a given delta? And by convention, we use 25 delta risk reversals. That was showing 0.5% negative skew. So the puts were 0.5% more expensive than the calls in terms of vol. And the 10 RR, 10 risk reversal, was the calls 2.5%, 2.5 vols lower than the puts. So, and this is how actually I see the world. So when I'm talking about positive and negative skew, you can see here at 9 months whether halving is going to happen. Both the butterfly, the 10 fly is the butterfly. So the 10 delta butterfly, which is the difference between the 10 delta puts and calls, vols, and the at the monies, that's 13.7%. Plus the calls are 13.5% above the puts. So that means that you take half reversal, add it to the fly, and that means that the 9 month call volatility is trading 20% above the at the money volatility. So there's a strong view of upside there, and actually I think that's probably slightly overblown, which is why I did my trade of the decade a few weeks ago with buying at the monies and selling the out of the monies. So I just wanted to cover that. Sorry.
All right. So everyone, that should be clear as mud, right? All right. I'll just quickly jump back to the poll. We'll take a couple of questions. We've already run over our time limit, and so I'm going to be quicker. So regarding our iron conduit we put on, which expires on next Friday on the 13th, 42% of you, and you can see the results, say sit tight and wait. That's actually my convention too. I'm going to sit with these shorter term things. I do that a lot. Longer terms, I take them off earlier. Then 38% of you said, hey, let's close the call side. Hey, we're up 70 something percent. Maybe just close it. That's good. And I like to do that. But if the market starts to go down and press the put side even more, we regret closing the call side. We thought, would have missed to squeak that extra money out of there and add some more protection on the downside. But I don't think there's anything wrong with doing either of those things, to be perfectly honest. I always break current, flies and condors all the time, or I'll break their wing, or I'll change the strikes, do all kinds of things. There's no rule we have to do anything in particular, but I like that. So everybody says sit and wait. So you know what? I'm going to sit and wait. So next Thursday will be the day before expiry. I'm not sure I'll have it. I might have to manage that position. But if we're clear on each side, I'll let it expire. If we're not clear, I might take action. But so far, the plan will be sit tight and wait. Okay, a question here from Stanislav. We can just go through a couple of questions and that's it. So Stanislav says, earlier I sold some out-of-the-money calls with auto DH, then began a strong movement in ETH. The price didn't reach my calls, about 1 to 2 strikes, and bounced. I got large losses on DH. After 2 days expired, calls didn't recoup the losses at all. Is it worth to roll out on price movement, even if it's not at the money?
Okay, so this is my bread and butter, to coin an English phrase. So auto DH means auto delta hedger, just for anyone who doesn't know. So Stanislav, you've come across the bane of systematic options books the world over. So when you're auto hedging, you kind of hope that you are therefore hedging away all of the effects of spot moves and therefore only trading the volatility. But of course, the auto hedger does incur losses because it cannot hedge the curve perfectly as we move. And also, you have to delta hedge according to the correct volatility surface. If you're just using the volatility surface that comes from the market, what you might find is that as the skew rises, if for example, now the skew is negative and you're short calls, your auto hedger, and we get a move up, your auto hedger actually isn't going to buy enough delta to hedge nicely. And if after a while of that, plus of course you're making small hedging errors all the way up because you're hedging periodically rather than continuously, and you're paying market fees if you really are going to hedge continuously. And then you might find that as the market goes up, the skew goes positive, and your delta hedger starts to hedge more aggressively because of the implied increased delta, because of the skew, and then the market might reverse. So now you've not hedged high enough on the way up, but the skew's reversed, and the market goes down, and your delta hedgers are now over hedging on the wrong side, and causing you losses in both directions. So it's an art to how to tune your auto hedger, and this is one of the reasons that I don't recommend anyone's auto hedger because it's I can't vouch for anyone else other than what I do for myself, and that's why I have a team who write my software for me, and we tune it continuously. And so, but long story short, the problem occurs when you've sold vol cheaply. Just selling vol and auto hedging it is not a guarantee that you're going to make money. Because if the market is doing their jobs properly, you won't. You still have to look for the mispricings, and that's why I trade the wings, because I find that I get more mispricing opportunities out there. I think market makers the market is extremely good at arbitraging away errors anywhere within $20-25, because that's what everyone trades. So yeah, there's a life lesson, a cheap life lesson for you.
Okay, and just to, when you were showing your spreadsheet and the delta, I think Alex came back and said what he meant is on Deribit you can actually switch the smile view from instead of looking at strikes over to delta. But okay.
Yes.
Time for one last question. We're way over time. Sorry, everyone. Paul asks question about hedging with futures. how do you calculate the needed size, and does the cost not offset your options theta income?
So long story short, if you want to hedge to 0 delta, you compute the delta of your options. You add in any delta that comes from the inventory you hold, the bitcoins in your account, and then you trade that many bitcoins of options. And when you futures, I beg your pardon. So, and when you enter in the futures trading screen, you can either enter your amount either in dollars or in bitcoins. So that's the short answer. The second part, does the cost not offset your options theta income? Yes, it does. And if you're going to delta hedge continuously, as I do, you better sell your options for more than they're worth. And if you're going to delta hedge your long options positions continuously, you better buy them for less than they're worth. Mm-hmm. Hence, that's my day job, is looking for these mispricings. Mm-hmm. Mm-hmm. If you don't want to bother looking for the mispricings, you can do what I do on my home save account, which is hedge occasionally when things get nasty, and trust the luck that the market's going to stay in a range. Mm-hmm. Which you should do in smaller size, right?
Yeah. Okay, that's it for today. Again, thanks everyone for joining us. Anyone who wants to join us day in, day out on our Telegram channel, head over to roguetrader.academy and sign up for a free trial, silver above, and you can have access to our real-time trade alerts and chat with us. And hey, for all of you giving me,
don't forget the gold account gives you the ability to actually have one-on-ones with us.
Yes, we do. I didn't want to plug us too much, I'm trying to be humble here, but check that out. Yeah, access to us, which I think is fun because we love chatting with people and we love helping people out, whether you're beginning or you're really sophisticated and looking for new strategies. So that's it for this week. Thanks for the advice on the Iron Condor. I'm going to let that cook for a little while. We'll see if we can run it right into expiry next week, but we'll see. Bitcoin's starting to show some strength, so we'll see if we get a bit of a push up. Other than that, see you next week, everyone.